Welcome back to the Mortgage Heroes Weekly Podcast, where we talk about how you can win in mortgage and real estate. Each week, we have a new topic to discuss and dig into. We share opinion, perspective, advice, and insight that helps to bring forward the most important topics of the market to the table. I'm Andy Cruz here in Business Development, and to my right, I have
Will Flores, Branch Manager of Mortgage Heroes, your VA specialist.
And to my left, I have
Brian Landeros, a.k.a. Brian Lends Money on Instagram.
Yeah.
Well, thank you guys again for being here. Quick recap. Last week, we talked about interest rates and who's getting into homes in 2023 already. So if you missed that conversation, you can go back one episode and hear all about what we're seeing from the front lines of mortgage. Yep. That was an interesting conversation. But this week, we have a very important topic to talk about. Before we get into that, just a quick reminder to share this show with people you know and like who can benefit from these conversations as they seek to understand what's happening in the market and how they can position themselves to win in mortgage real estate as well.
That's right. Perfect.
We got a doozy on the table today, guys. We had the most recent Federal Reserve interest rate hike decision and press conference. We're going to talk about both, but we're going to do it in order. So number one, we're going to talk about the rate hike. Number two, we'll talk about what they said and didn't say. Are you ready?
We are ready, Andy. Let's go.
As
Drum
ready
roll,
as we'll ever be.
Okay, first of all, the Federal Reserve and Jerome Powell did what they said they were going to do. Well, they didn't say. We did what they were expecting to do. They did a 25 basis point rate hike, which is 0.25%. What do you guys make of this right out the gate?
Well, right out the gate, we already anticipated 25 to 50 basis points. Yep. So the 25 was, I already think that since it was already anticipated weeks ago, it was already kind of baked into the interest rates. We actually saw interest rates get better.
Yeah,
they went up all the way to like 55 basis points better, and then went down to 37. So we all know the market is volatile based on the information and everything. Jerome Powell twitches a little bit. I think he had a smile, and that's why rates kind of went in our favor today.
I just feel that it goes based off the sentiment and then the way that they deliver the news in the conference that the investors in the market really takes it, from what the vibe they get from his conference. Yeah. And I believe it was more on the positive side than, the negative side, which is surprising. And I know we have a lot of information to get in there, but I was very, 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 surprised that, the market took it like that. And I'm actually excited because, that's good for us and buyers.
I'm telling you, Brian, Jerome Powell was smiling, okay?
Yeah, so that in itself was enough to influence the markets, right?
Remember, if he has a frown and looks like me, then we already know.
There should be like an over-under, like how many times does he smile? Is that good for rates, bad for rates?
Not really. He is the most influential man there is out there.
Dos Equis.
It's not the Dos Equis
They should definitely contact him now.
It should have always been Jerome Powell.
Sponsorship needs to change.
What a great branding campaign for that brand. But so 25 basis points, what they came out with. This is one of those instances where the decision itself was right. Everyone pegged it. Everyone was talking about it. And the other thing too is that if there were to have been a 50 basis point hike, someone would have already would known that, and they would have kind of like nudged the headlines and commentary a little bit in the days leading up to that. That didn't happen. So for as far as this one's concerned, it's pretty much par for the course. But there were some interesting things that they talked about. We're going to jump into that right now. The decision was the decision. Now let's talk about what they talked about and what they did not talk about.
Oh, one thing before we get into that.
Go for it.
Guys, it's very important to remember that when they speak about raising the rates, they're not speaking about mortgage rates, right? So just so you guys get an idea, remember this is about rates that have to do with credit cards, auto loans, and the way that banks borrow money from each other.
Correct.
So just full disclaimer. Yes. Don't forget, guys, because a lot of people take it and like rates are going to get spiked up. But guys.
And there are instances where what the Fed decides, the market follows suit as a byproduct of the indirect influence. But I'm glad you clarified that. That is not the case all the time. As you were just saying, rates got better, even though they increased their Fed funds rate today.
Because we'll hear our industry start talking like, "Hey, rates went up, rates went down." But come on, like let's just be fully transparent here.
Yep, easy way for us. For some lenders just to put it out there too.
Exactly. I just want to make sure
kind of get people to think a different way.
Everybody gets
get the phone to ring.
Yeah, right. Exactly.
Correct.
Well, the first thing I want to bring up is that, like literally in the first sentence or two, he mentioned inflation like right away. Inflation and the impact of our rate decisions. We have not yet seen the effects of them still. So they are still, even after March of 2022, saying that they have not yet seen the full effects of their rate decisions. And of course, then later in the press conference, he says, and we're going to also continue to have other rate hikes down the time horizon. So this is really telling because they're focusing on price stability, like they always say, and went as far as to say that ongoing increases are still appropriate to maintain that restrictive price.
Absolutely.
policy.
I mean, this 0.25% increase it barely does anything. Some people saw, we're already seeing the effect of the rate hikes from last year, being one of the largest rate hikes ever to be recorded in history. And here we are, beginning of the year already, February 1st. Can't believe that. We got our first rate hike of the year. It's going to continue on happening. And just expect that only because the ripple effect of this right now, we're not going to see until like 6 months down the line or something like that. It's something that it takes time for us to really notice the true effect of it.
And I think that's a good point you're making because we've been talking about this in Monday Mortgage Minute. In previous episodes, you and I did prior to this show format where we talked about the effects of those decisions. They ripple through the market. They find themselves in the wholesale side of things first, and then the wholesale side becomes the consumer side. The consumer side becomes the data that they end up making decisions based on to look forward. So the forward guidance is a little bit... I will say a little bit veiled because he didn't want to say too much about what they were talking about. Someone actually tried to ask him a part of, hey, so during your conversations over the last 2 days, did you guys talk about that? He's like, hold on now. You'll get the meeting minutes in 3 weeks like you always do. So he made very specific note that they were not going to let the cat out of the bag on any of the factors they were considering when coming to this conclusion.
And we still got more data coming out, right, Andy? This week?
There's tons of it.
There's the JOLTS.
Yeah, JOLTS came out. Yeah, the JOLTS information was back higher than expected again. It was back in the 10 million range, and now it's back over 11 million of job openings.
But is it true?
Is it true? I know. Brian's referring to the Labor Department that overestimated job growth by a million. I mean, let's take a pit stop there. We hear these things. We expect these things. We project what the Fed's going to do. They make their decision based off data they're giving. And yes, a couple months ago, it was revealed that the Bureau of Labor and Statistics overestimated job growth by 1 million jobs.
Wow.
So to make decisions that are qualified on a softer jobs market or needing to see softening in the market, meaning more unemployment, it's really hard to then digest that we're hearing these things. It's impacting the market directly. But then, wait, what do you mean the data was that far off?
Well, and here's the other thing. They pretend not to have such data. For instance, the Fed started meeting yesterday.
Yeah,
correct. Right? Today was a decision. There's still more information that's going to come out by the end of this week.
And I believe they do it strategically, not to just let everything go mayhem right off the bat. So like that's what he said. 3 weeks, you'll get the rest of it, and in 3 weeks, hopefully things are easing up a little bit, so we can let the next train of
one of the things they say in life, you got to be prepared. I think they're really well prepared ahead of time.
They should be. I would hope so.
Yeah, they're going to be the ones receiving the data before anyone else. Yeah. But I think in this instance, it's the quality of the data that now becomes the issue.
Correct.
And so that kind of caught my attention today when he was saying that before they change a shift in policy, they're going to have, quote, substantially more evidence before making a change. And I was like, okay, well, that's great on the surface level. But again, if the quality of the data is compromised, then having substantially more of it may not actually even help us make the right choice.
Yeah. Is that evidence maybe eggs just costing more money now?
Yeah, way beyond that. Eggs.
Apparently eggs is it's a delicacy nowadays.
I had to go to the neighbors already and ask.
So actually, I just picked up 3 chickens, and I guess my cow's coming in next week because, we're just...
Andy, so, with all these things that are happening, I've never seen such a thing ever in my life. What, based on the conversation that you heard with Jerome Powell, what's your personal take on all of this?
Well, okay. I think a lot of what he did today was just to reiterate what he's already said, which is their terminal rate will be higher than what they originally thought, and that rate hikes will have to go longer than they originally anticipated when they started March of 2022. That was both reiterated today. I think the real telling point is that is that they are concerned about the inflation becoming entrenched. And this goes back to something we talked about in Monday Mortgage Minute a week ago, where the advanced GDP reading top line was 2.9%. Mm-hmm. But when you extract inventory replenishment and government spending from that, it was actually only 0.2%. Okay. So of the 2.9% growth, only 0.2% can be attributed to the consumer. Wow. So that's I think that's a hand-in-hand comment about this concern they have about if inflation persists for longer than expected, it becomes entrenched. Gotcha. Well, we have that problem. Now, I'm going to take another angle here. It's a super nerd hat. Ready? Yeah. You also have the labor market, which is still really strong. And even though people are announcing they're going to do layoffs, those individuals being laid off will enter the unemployment line whenever they so choose, not their employer. So the unemployment rate, whether someone goes into the unemployment line in 2 weeks or 3 weeks or 4 weeks or 6, will change what the unemployment rate looks like. But that unemployment rate goes into the mix of the decision they make. And if wages keep enough pace with the current cost of employment for those who are employed, then inflation actually could be entrenched and they will not go back to 2%.
Gotcha.
That is what I'm concerned about.
Gotcha. So we're basically saying that, from the layoffs that are to occur, until they run out of money, essentially, and they decide to go into, unemployment, then we'll get actual numbers of who really is unemployed. So
yeah, you got to remember, when a company announces they're going to release, 10,000, 12,000, 18,000 people, some of those people will also get severance. Some of those already may be very close to retirement. So there's a broad variety of types of people becoming unemployed, and not all of them will go get in line for unemployment day one.
I guess that's what I'm asking, because is that, an opportunity for the numbers to get distorted again, where it's like if this company is saying, hey, X amount of workers are going to get laid off, person that gets data says, okay, well, that's 12,000 jobs that are now gone. Do that get factored into the unemployment?
It's possible.
But in reality, the people are probably just still at home, like you said, enjoying their severance pay, still got savings, or haven't fully got the mindset that, hey, I'm actually fired now and I'm not going back.
Yeah. The entrenched part, though, I think is part and parcel of what you're saying, though. I think that is going to become the biggest issue. Because as they keep rates, as they go to a higher terminal rate and they have to keep it there higher longer, that trickles into the economy and makes things more expensive. So they're right to be concerned that this continued inflation will become entrenched and then we just become permanent. And then the word transitory is almost like it never existed. They said it for so long and it's completely not even coming close to being true.
Have you heard that word recently?
Yeah.
No.
Quite a bit. Not entrenched.
No. Transitory?
Yes. I've been hearing that already. That was our market from big financial and big investors. They've been actually discussing this for over a year and a half. I've been hearing that word.
Yep.
And here we are, and there it is. So,
well, there's two things I wanted to make sure that I brought up that we keep our eyes on moving forward. Is number one, the word and month, March. March. It was mentioned so many times today in the press conference. We're going to look at March. We're going to collect data till March. And at the meeting, March, because they know we're only 1 month into the new year. Mm-hmm. There's a lot of data that's going to be, it's all lagging. And March will have to be a much more of a introspective, maybe harder, more narrow decision-making process.
And that's actually, in the years that I've been in this industry, that's usually when it is.
Yep.
That's March has a huge impact. In the last few years, that's when I saw the rates just skyrocket during that time, because of data again. It comes out right there, and that's what the Fed uses to really see the determining factor, how we're going to move forward with the year. I saw that. I mean, 2020, I remember when Tesla stock went really low, and it was March. And it was like the best we've seen. And then after that, it was just,
crazy. I don't want to talk about it.
I'm not buying anytime soon.
So March was one. And then the other thing, too, is that then I want to kind of end on more of a positive note, which is he did mention, and it said this about, 2 times that I caught, may have said it more, is that the disinflationary process has started. In my recollection, that's the first time I've heard him say that.
I did hear that.
With all these press conferences, that the disinflationary process has started. And but it was also kind of like with an asterisk and a disclaimer, where not in all sectors of the economy. And so broadly until more sectors, he specifically said 6 or 7 sectors we're watching until they also start to have disinflationary pressure or their disinflationary processes started, then we'll feel more confident that it's true. And they're confident that it's actually happening. Yeah. They did talk about housing being the number one, they're getting punched in the gut big time.
Yeah, he did say that.
I mean, it's had a huge effect.
Yeah.
It's had a huge effect.
I mean,
16 years in the industry, again, I've never seen, even in my life, haven't seen the COVID.
Yeah.
Haven't seen this type of market.
Yeah.
Everything's different about it.
Yeah.
You know, people compare 2008, like there's no comparison. Very different markets, you know, just like the Great Depression, we can't really compare it. You can kind of say there had similarities in some ways.
Yeah.
But this is just different, you know. There's a shortage of homes. As a matter of fact, I just heard a big developer actually going to develop in LA because the mayor decided, like, hey, we're having housing issues.
Yep.
So now Costco is kind of going into it where they're building a Costco underneath this 800 apartment
800 unit complex.
Exactly. How's that going to look?
On top of a Costco.
Just go down to
like on top of a Costco.
Hey,
correct.
Yeah, you're looking for a snack at 4 PM. Just go to aisle 46. I got a little sampler at the end.
Yeah. Oh, okay, great. This is the direction. What I'm going with is this is how everything's changing.
Yeah.
Everybody has to improvise and collaborate.
Yeah.
How do we bring this unity to make a difference out there in this community?
Well,
which is crazy.
It's unique and creative problem solving, which we talked about a couple weeks ago, where the market's going to come up with new solutions. This is one solution for housing.
That's it.
I saw another article, which I won't go into now because we'll talk about it another time, but where loan servicers are now coming up with alternative methods of repayment because they're concerned that when there are an increase in defaults, they're going to end up taking properties back, which they don't want. Then that puts a glut of homes on the market, and then that kills values, so on and so forth. Correct. So we'll get into that in a future show, but I saw that this week too. Wow. And I was like, wow, they're even going to having to get creative on the servicing side so that they do not recuperate or take back that properties, and they can continue taking payments of some sorts.
We saw that happen in COVID.
Yep. So a lot of modifications and forbearance and that kind of thing.
Exactly. So my question, Andy, based on all this information, if I'm a buyer, what do I expect? What can I'm not saying you have to have a crystal ball, but what does it look like in a few months?
I would be very surprised if we got into the 4s with rates. I think we're going to hover in the 5 range to 6 range with your normal credit that we quote all the time with people. Good credit, low debt to income ratio. They have some down payment.
Gotcha.
Especially if it's like VA. And here's why. The market will find itself under and gain some footing on their own. And because the Fed is not buying so many mortgage-backed securities, the open market doesn't have their partner in crime, if you will. And the Fed even made mention today of they're going to continue rolling off their balance sheet. And so the Fed is reducing their participation in the market a lot. And so then the market itself has to decide, well, what's our tolerance for risk? And I don't think they're going to take tolerance for risk under 5% because how do you sell that? So, how do you go tell a hedge fund, give me $1 billion and I'm going to give you 3% return?
And that's what I was going to say for our normal viewer that, this is great conversation. We understand it.
Yeah.
But, for our average viewer, can you simplify that?
So, I mean, can I?
Yeah, go for it, Brian.
So what I would say, if you're in the process of buying a house, forecast what it's going to look like 0.5% above, 0.5% below, so that you understand what it is for you to know at a higher payment, at a middle payment, and at a best case scenario payment, right? So right now off the bat, when we approve someone, or whenever you get approved, everybody's trying to give you the lowest rate possible, right? Yeah. Great. But be proactive and ask, hey, okay, that's the lowest rate possible today. If I buy it down, how does that look? If it goes up, how does that look? So that you already in your head have a plan, have a clear idea of what it's going to look like in perspective as far as your financial situation. And then from there, do your due diligence. Is that something that you're able to, take on? If that's something that, you're going to be able to make payment if the rates don't come down in 2-3 years. So it really comes down to understanding your finances as a regular person because, we could get all this information and tell you all this information. But like you said, what does that really mean for the person at home? Well, rates are going to figure out themselves and they're going to do whatever they have to do. Yep. But you can't control the market, but you can control your finances. Correct. You can control how you prepare yourself, how you spend your money.
Stick to McDonald's.
What you're listening to, how you're making making your decisions. So I would honestly say that it's more of a personal task to prepare yourself by, listening to the right information, understanding your budget, how much money's coming in, how much money's going out, and where you could cut expenses to, ultimately get to your goal of buying a house. If that is your goal in 2023, there is options. There is things in place that could help you get into a house, minimize the payment if you need to. It's just doing the right due diligence, I believe.
Yeah, and that's a great summary, Brian. Thank you for putting it in those terms. I just think that there's going to be a lot of uncertainty in the market because the Fed is not participating like they used to anymore, and that means that the banks are on their own. And
now that the banks are taking more risk and less participation from our government, right?
Yep.
That means
they're going to price that in.
What means?
I think that means rates are going to remain elevated. I don't think rates are going to go back to the 3s again. Even the 4. I don't even know if we're going to see 4. If we go back in history and we look at this episode and we got into the 4s, the high 4s to 4.5s, I'll be very surprised because that would mean something would have to change fundamentally. And right now, the Fed is going like, "Good luck, guys. Have fun on your own." And that's changing. Changing pricing.
And that's what we're talking about, right? Like, why were rates so low? Well, if you recall, back when they were in the 2s, the government was buying
$90 billion a month of mortgage-backed securities.
Right? And what we didn't want to see was then selling it off.
And what happened?
Because then they knew as soon as we start selling off, what would happen to rates?
Spike right back up.
And so investors, and that's where I wanted the simplification was, now as a home buyer, I get to understand if rates are going up, that's because now we're leaving it up to the banks, to investors. And the way we got to look at that is if I'm investing my 401k money, right, we're able to go to, Wall Street and buy whatever stock we wanted to. Do we want to invest in the bond that's paying at 2%, or would you rather invest when now it's paying 5-6%? So those are the differences out there.
And that changes everything. When it comes all the way down to this level of the market, that changes what we are able to offer people.
That's it.
So thank you for bringing that up. Really I know we talked from a couple of different angles about that topic, but I think it's important for people to know.
Yeah. Again, it's like for me, I understand it at third grade level. That's me. Andy, he's Einstein. They need formulas.
He's at a college course.
You see what I'm saying?
I'd love to have that guy's hair.
And my numbers, me being Hispanic, I need either frijoles right here or a calculator, otherwise I can't do the math.
Oh my gosh.
So but that's why we're a team. We got experience, we got the brains, and we just got great hair here.
That's it. Beauty.
And now, in addition to great hair, coats.
I have to control what I'm able to control. So
that's it.
I don't got the smarts or the years on me. So.
Well,
play the look.
I want to make sure that everyone who's listening to this or watching this on YouTube understands that, if you have questions or you want to dive in deeper about these things on the economic side, you can let me know. Macro side, let me know. You want to talk about your home loan situation, whether you're buying your first home, second, third, fourth, you need to buy an investment property, call Will. Call Brian. Have these conversations right now, especially if you have a life change coming up in 2023.
Right.
Don't wait until the life change is 10 days away to then make a big decision about where you're going to live, how you're going to get there, what you got to do. Do those things now in preparation for, put yourself in a position to win.
And that's ultimately, what I've been pushing out the most this year to all my clients and my, database, as well as like everybody that follows me on social media, is prepare. Be ready, because opportunities are going to be there. Correct. It's just, it's going to come down to who's the most prepared and who's ready to pull the trigger when the opportunity actually does come to you.
That's it.
All right.
Like it.
Well, thank you guys for a great conversation today. I know that we had a lot of nerd stuff we talked about, but I appreciate you being a part of this. I hope that the people who have listened to this are learning something.
Yeah. Yes.
And we're going to continue doing this every single week. We bring a brand new show to you guys. And then, of course, when we have the next Fed meeting, we'll break it down and talk to you again as well. But for everyone who's watching and listening, thank you again for participating in the Mortgage Heroes Weekly Podcast. If you need help, you can reach us online at mortgageheroes.com, Facebook, Instagram, YouTube, email, phone, or text. Remember to share this show with the people you care about. We appreciate you very much, and we will see you again next week.
Yes.
Bye, guys.
Please send a review. We will love to read it and share it with the group and the team. We would love that. So your feedback's greatly appreciated.
Yep. Also, drop a comment to see who's your favorite one to listen to. Is it Will? Is it Handy? Or is it me?
Oh,
there we go.
Let us know, guys.
Feedback.
We'll see you next week.
Loser gets kicked off the show.
That's it. We'll cut their hair.
No! Oh, wait. I don't know I'm going to be in.
See you guys.
Okay.